Welcome to this monthly update for November. I'm Julia Lee, an Equities Strategist at Bell Direct. Unfortunately, after what was a very weak October for the Australian share market, it's been followed up by more weakness in the month of November. We did see the ASX 200 index down 1.9%. Generally, when you do see losses, you expect the Small Ordinaries index to show larger losses, but that wasn't the case this month. We saw a loss of 1.4% for the month of November. G8 Education, Appen, which are all smaller stocks, helping the performance of the Small Ordinaries index. But on the flip side, we saw the mid-cap index being a negative standout, and most of the mid-cap index actually finishing in the red. 33 out of 51 stocks in that index finishing with declines. The worst being stocks like CYBG down by 25%, BlueScope Steel down by 22%. And while the losses were quite big, the gains were relatively muted. The best performers in that space were stocks like Cube, which were up by 9%, and REA Group up by 6%. The best list was dominated by small cap stocks in the index, but the worst was dominated by profit downgrades and weak outlooks. CYBG got caught up in the financial stock sell-off related to Brexit, hitting bank stocks over in the UK. But those losses were accelerated with the messy result from CYBG, which did see a step up in the price of share price falls and also more write-downs related to PPI. Let's focus a bit more on engineering and construction, which dominated the worst performing list in the month of November. And engineering construction activity here in Australia for the third quarter was down by 4.5%. Some of that was related to wet weather conditions, but also tightening credit conditions in the residential housing market, saw a delay of projects and also difficulty in staffing, adding to price woes. In fact, we saw RCR Tomlinson moving into administration, and I guess it was as a result of fixed price contracts, which a lot of these engineering construction firms tend to do, and then variable costs. In the case of RCR Tomlinson, the solar contracts that it bid for were at too small a margin, and with increasing labor costs, it was looking at write-downs. And of course, with only around about 3 out of those 7 solar contracts coming online, there was the risk of more profit downgrades and more write-downs there. Lendlease looking to offload its troublesome engineering division. We saw Fletcher Building with its troubles continuing, this time with the housing side hitting its business. And we also saw Macca, stock code MLD, with a profit warning. But in addition to the engineering construction area being weak on the Australian share market, we were hit by global factors as well, and the key one being the oil price slide. We saw oil prices dropping a massive 20% in the month of November. As you'd expect, some of those smaller, more leveraged plays in oil were hit hard, with FAR down by 60%. We also saw Sundance Energy down by 40% and Mermaid Marine down by 28%. Some of the larger companies did fare better. Caltex and Washington Soul Patts, of course, not directly exposed to the oil price, so outperforming, but Oil Search was down by 7%. But generally, those Australian large cap oil companies faring better than the oil price performance. But I guess the bigger question is, are the equities markets and oil prices signaling a slowdown in global growth? We are seeing a number of red flags, but ones that we are watching out for is earnings growth moderating, which would mean it would be more difficult for equity share prices to continue rising. Also looking at margins peaking, which would be a negative sign for equities and earnings, rising bond defaults, as well as deterioration in housing. But ending on a positive note, and the property sector was the best performing on the Australian share market this month, with a rise of 2.5%. In particular, non-retail names have been seeing upgrades, and we prefer non-retail names given the softness in some of the commentary coming through from retailers throughout AGM season, including from Michael Hill Jeweller, The Reject Shop, Flight Centre, Super Retail, as well as Nick Scali. Having a look at industrial and office property plays, and they continue to see positive earnings revisions, which have helped the outperformance for the likes of Charter Hall, Dexus, as well as Goodman Group. And in fact, if you have across lease agreements, these tend to be multi-year agreements. So these type of companies should benefit into FY20, given the gradual resetting of leases to reflect the current higher market rents. We saw year highs in the month for stocks like BWP Trust, Charter Hall Retail, Goodman Group, Investor Office Fund, as well as SCA Property Group. So all in all, it's been another tough November for the market, keeping a close eye on global growth and whether we continue to see strong global growth or that global growth is rolling over, which would make it a more difficult environment for equities. I'm Julia Lee, an equity strategist from Bell Direct. Hope to see you next month.